Hey there, wealth builders. Welcome back to the Reading Mindset, where we unpack the best books to supercharge your financial journey. If you've ever dreamed of creating lasting wealth, there's one skill you must master: the art of investing. And when it comes to investing, stocks are one of the most powerful tools out there. But where do you start? Don't worry, today's book summary is your ultimate beginner's guide to stock investing. We're diving into the 5 Rules for Successful Stock Investing by Pat Dorsey, a book packed with timeless wisdom to help you invest smarter and build wealth that lasts. Whether you're new to the stock market or looking to level up, this summary will break down the key lessons and show you how to apply them in real life. So, grab a notebook, hit that like button, and let's get started. About the author. Pat Dorsey is a rock star in the investing world. He's the founder of Dorsey Asset Management, a top-tier investment firm, and previously served as Director of Research at Actionable Captiva Trust Company, working with high-net-worth clients. With a master's degree in political science from Northwestern University and a bachelor's from Wesleyan University, Pat's expertise shines through in his 2 influential books, The 5 Rules for Successful Stock Investing and The Little Book That Builds Wealth. Today, we're exploring the 5 game-changing rules from his stock investing masterpiece. Why this book matters. If you're new to investing, the stock market can feel like a maze. Which stocks should you buy? When should you sell? How do you spot a company worth your hard-earned money? If these questions have ever stopped you in your tracks, this book is your roadmap. By the end of this video, you'll have a solid foundation to make confident, informed investment decisions. Let's dive into the first 3 chapters, the 5 Rules, 7 Mistakes to Avoid, and Understanding Economic Moats. Chapters 1a-3, the 5 Rules, 7 Mistakes, and Economic Moats. Investing success isn't about chasing hot tips or flipping strategies. It's about building a smart, consistent plan and sticking to it. Pat Dorsey lays out 5 essential rules every stock investor needs to follow. Do your homework. You wouldn't buy a car without researching it, right? The same goes for stocks. Before investing, dig deep into the company. What do they do? How do they make money? Who are their competitors? Study their financial statements and understand the industry. It takes effort, but it's the foundation of smart investing. Find an economic moat. An economic moat is a company's competitive edge. Think a strong brand like Apple, a cost advantage like Walmart, or a network effect like Amazon. Companies with wide moats are built to thrive long-term, so make finding them your mission. Insist on a margin of safety. Even the best company can be a bad investment if you overpay. The margin of safety is your buffer, buying a stock at a price lower than its true value. For example, in the early 1990s, Coca-Cola was a fantastic business, but investors who paid sky-high prices missed out on great returns. Always buy with a cushion. Think long-term. Trading stocks like you're flipping pocket. Copyright loan cards racks up fees and taxes, eating your profits. Wealth comes from buying great businesses and holding them for years. Patience is your superpower. Know when to sell. Don't obsess over daily stock prices. Instead, monitor the company's fundamentals. If their moat weakens or the industry shifts, it might be time to sell. Stay focused on the business, not the ticker. But even with these rules, pitfalls await. Pat highlights 7 common mistakes that can derail your journey. Chasing risky stocks. Betting on volatile stocks for quick wins is like gambling. It rarely ends well. Stick to strong businesses with real advantages. Believing this time is different market cycle. The dot-com bubble of the early 2000s taught us that hype doesn't rewrite history. Stay grounded and learn from the past. Falling in love with products. Love your iPhone? That doesn't mean Apple's stock is a buy. Invest with logic, not emotions. Panicking in downturns. Market drops are scary, but they're also where the best opportunities hide. Don't sell in fear. Buy wisely. Timing the market. No one can predict market highs and lows consistently. focus on owning great companies for the long haul. Ignoring valuation. A hot stock can still be a bad deal if it's overpriced. Always compare price to value. Blindly trusting earnings. Earnings can be manipulated. Cash flow is the real deal. A strong cash flow signals a healthy business. Now, how do you spot a company with a true economic moat? Here's Pat's 4-step process. Step 1. Check profitability. Look at cash generation and compare returns on assets to peers. Higher returns often mean a stronger business. Step 2. Identify the moat. What makes this company untouchable? A unique brand? Exclusive patents? Pinpoint their edge. Step 3. Assess moat durability. Will this advantage last 5, 8, 10 years? A temporary edge isn't enough. Step 4. Analyze the industry. Understand the sector's health, the sales trends, profit margins, and competition intensity. Master these steps, and you're on your way to picking winners and avoiding losers. Quick break. Loving this summary so far? Hit that subscribe button and ring the bell so you never miss a video. Drop a comment below. Have you made any of these investing mistakes? Let's chat. Chapters 4a6. The language of investing in company analysis. To invest like a pro, you need to speak the language of finance. Don't worry, it's simpler than it sounds. Every company has 3 key financial statements. Balance sheet, a snapshot of what a company owns, assets, and owes, liabilities. It shows financial health at a specific moment. Income statement tracks revenue, expenses, and profit over time, like a year. It tells you how much money the company made or lost. Cash flow statement follows the actual cash moving in and out. Profits on paper are nice, but cash is king. Here's a quick example to clarify. Imagine Colgate sells $1,000 of toothpaste to a store, but the store has 60 days to pay. The income statement records the sale as revenue, even without cash. The balance sheet lists the $1,000 as a receivable, money owed. But the cash flow statement, it waits until the cash hits Colgate's bank. This distinction matters. A strong sales without cash can spell trouble. Now, let's analyze a company in 5 stages. Growth. How fast is the company growing, and why? Is it selling more, raising prices, launching new products, or acquiring others? Make sure the growth is sustainable. Profitability. Does the company turn investment into profit efficiently? Compare cash flow to earnings. A healthy cash flow backs up reported profits. Financial health. Check debt levels and liquidity. Too much debt is a red flag. Strong companies have cash to weather storms. Bear case. Play skeptic. What could go wrong? New competitors? Tech disruptions? Regulations? Know the risks before you buy. Management, covered later. With these tools, you'll analyze companies like a seasoned investor, rooting your decisions in data, not hype. Chapters 7a9. Evaluating management. Great companies need great leaders. The 5th stage of analysis is evaluating management quality, and Pat breaks it down into 3 areas. Compensation. Check the proxy statement to see how much executives earn. Are their salaries tied to performance, or are they cashing huge checks regardless? Compare CEO pay to competitors. Excessive pay is a warning sign. Character. Are managers ethical? Watch for red flags like family members on the board or shady contracts. For example, the CEO's spouse running a side business with the company. Trustworthy leaders prioritize shareholders. Business operations. Are managers competent? When problems hit, do they act decisively or dodge accountability? Look at cash flow trends. For example, in the late 1990s, Lucent Technologies reported $3.5 billion in income but had crumbling cash flow due to unpaid sales and excess inventory. Management ignored the issue, and the company tanked. Actions speak louder than earnings reports. Great management aligns with shareholders, acts transparently, and navigates challenges with skill. Spot these leaders, and you're betting on long-term winners. Chapters 10, 8, 12, Valuation and Intrinsic Value. Price isn't value. To invest wisely, you need to know a stock's intrinsic value is true worth based on future cash flows. Economist Irving Fisher nailed it 60 years ago. A stock's value is the present value of its free cash flow, cash left after expenses and reinvestment. Why present value? $1 tomorrow is worth less than $1 today. You can invest today's dollar, and future cash isn't guaranteed. The further out the cash flow, the less it's worth now. Let's apply this to a real company, Advanced Micro Devices, AMD, in the early 2000s. Economic moat: AMD's free cash flow was negative due to heavy reinvestment. Some reinvestment is fine, but consistent negative cash flow raises concerns. Financial health: by 2002, AMD had $1.9 billion in debt, a massive burden. Management: CEO Jerry Sanders earned $1 million annually, and executives were well paid despite shaky finances. This misalignment screamed risk. Valuation: with losses piling up, weak cash flow, and high debt, AMD was a volatile stock and not a safe bet. The verdict? AMD wasn't a smart investment then. By analyzing moats, finances, management, and valuation, you can dodge risky stocks and find better opportunities. Chapters 13a-15, Healthcare and Consumer Services. The healthcare sector is a goldmine for investors because it's tied to human survival. Pharmaceutical companies, with strong patents and high barriers to entry, can deliver stellar returns, but drug development is risky and costly. Biotech startups are tempting but volatile. Only invest if you understand their products and market. Medical device companies offer steadier returns, but watch for regulatory changes. In consumer services, think restaurants, retailers like Target, or brands like GABA. Growth is fast but fleeting. Quick service restaurants, like McDonald's, and full-service restaurants, like Olive Garden, thrive on loyalty and strong brands. McDonald's dominates, but most chains struggle to sustain early success. When investing, prioritize companies with loyal customers and competitive edges over rivals. Chapters 16a-18, Business Services, Airlines, and Banks. Business services cover waste management, advertising, and airlines, split into three types. Technology-based: data processors scale well and can be great buys when prices dip. People-based: consulting firms rely on expertise but are less scalable. Hard asset-based: airlines and waste management need huge investments, making them capital-intensive. Airlines are tough and most deliver poor returns due to high costs and competition. Invest only after confirming long-term profitability. Banks face three risks. Credit risk: losses from unpaid loans. Liquidity risk: inability to meet short-term obligations. Interest rate risk: rate changes hurting bond values. Choose banks with stable income growth to weather economic swings. For all business services, check scale, cash flow trends, and realistic growth projections. Chapters 19a-21, Software, Hardware, and Media. Software is a high-stakes, high-reward sector. Development costs are steep, but distribution is cheap, letting winners like Microsoft scale fast. In databases, Oracle leads in tech, but IBM and Microsoft compete on price. Focus on growth potential and sustainable moats, not just cool tech. Hardware is brutal, a constant innovation and price wars crush margins. Dell thrived by mastering low-cost production. Look for companies with cost advantages to beat the competition. Media offers long-term potential if you find cash flow machines. Check balance sheets for low debt and steady reinvestment. Ignore hype, hot trends fade, strong fundamentals endure. Chapters 22a-23, Telecom and Consumer Goods. Telecom rarely delivers blockbuster returns. Weak moats, fierce competition, and massive network costs make it risky. Look for companies with strong balance sheets and adaptability to tech changes. Consumer goods, so think food, household items, or personal care are steadier. These essentials sell in any economy, offering reliable returns. Seek companies with strong brands, loyal customers, and smart cash flow management. Always buy with a 20–30% margin of safety to protect against downturns. Conclusion: your path to wealth. Investing without research is gambling. This book arms you with the tools to invest wisely, the 5 rules, 7 mistakes to avoid, and a framework to analyze companies across industries. You now know how to spot economic moats, evaluate management, assess financial health, and calculate intrinsic value. Most importantly, you understand risk management as the key to lasting wealth. You're ready to approach the stock market with confidence and discipline. So, what's your next step? Start researching a company, apply these principles, and share your findings in the comments. If you loved this summary, give it a thumbs up, subscribe for more, and check out the 5 rules for successful stock investing for the full deep dive. Thanks for watching, and I'll see you in the next video.